Asset management versus hedge funds. Which is best for you? To become a successful investor, you can either plan, execute, and monitor your own investments, or entrust those tasks to experts working at two specialized institutions: asset management firms and hedge funds. Despite the similarities in both investment styles, each option has its own subtleties that can more or less match your personal financial situation. Find out what works for you before making any financial decisions in the long run. Welcome back, folks, to another edition of Sweetie Kiwi. I'm very happy to have you today. I hope you are doing fantastic. You are doing marvelous. And if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about the distinction and similarities between asset management firms and hedge funds. Now, what is asset management? Now, asset management takes a strategic approach in managing your assets. And again, it does this within the confines of an investment portfolio, and they do it strictly for the sake of strong returns, right? Now, wealth management is different because wealth management is more goal oriented. Now, when it comes to asset management, what it does is exactly what it sounds like. It manages your asset. So I'm talking about your financial holdings. I'm talking about stocks, bonds, mutual funds, ETFs, and other investments you make to try to grow your wealth and prepare for the future, right? So an asset manager typically will help you determine which investments are the best suited for your financial situation, right? So you'll have a conversation with him or her about, asset allocation, risk mitigation, hedging. He or she will help you how to divide your investable assets among different asset classes so you don't put all your eggs in the same basket, right? So you got to have a conversation with your asset manager around what percentage should be in growth products such as stocks and what percentage should be in fixed income products such as bonds and treasury bills. All right. Now, the thing here is that asset managers make money based on a percentage of asset under management, right? Rates really vary depending on the industry you're in and the size of the balance, right? Now, the thing here is that asset management also tries to find a good ground, a common ground, a good balance between risk tolerance, whether you are risk averse or risk taker, time horizon, liquidity needs, and all of these things is put into an asset allocation plan. All right. So the thing here is that if you want higher risk, let's say you want higher risk, as we all know, comes with high rewards, right? And low risk comes with low rewards. So you got to really find a way to balance those two. Now, the asset manager is not limited to stocks and bonds traded on public exchanges, such as the New York Times Exchange or the New York Stock Exchange rather, or Nasdaq. No, they can also invest in ETF. Those are exchange traded funds. They can invest in mutual funds, in real estate, private equities, right? So that just understand that. So that when asset managers usually target high net worth individuals as potential clients. This is because if you remember what I said earlier, asset managers, they charge significant fees based on a percentage of your asset under management, right? And this can be very difficult to afford for your average clients. All right. So the more you invest, the lower your fees are likely to be. Now, so this is about asset management. Now let's talk about wealth management. Now, asset management, as I said earlier, focuses on investments. Now, wealth management takes a much broader view, right? Because wealth managers try to look at a person's or family's overall financial situation and take steps to maximize their wealth and protect it down the line. Because the idea here is not just to grow, it's also sometimes to preserve the capital. So preservation is very important. All right. Now, so the wealth management entails a host of forms and includes a number of services, including tax planning, for instance, education planning, legacy planning, estate planning, insurance, right? Everything from life insurance to life insurance. You have charitable giving and retirement planning. So think of it as a one size fits all, or an all-in service, or an all-in shop. Wealth managers try to be everything and anything for their clients, because those clients are looking for a more holistic financial plan, and they're trying to ensure that their wealth will be protected and preserved over the long run. Okay, so that's very important. They're more cautious. So if you have an asset manager, they're not providing any tax planning for you, any education planning, any legacy planning, estate planning, insurance, as wealth managers do, right? So this is the big distinction to remember here. Now, wealth managers like asset managers are also often paid through a percentage of asset under management. Right now, in a few countries, some are paid a flat or hourly fee, but that's more the minority. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you're having a good time here. And if you love the quality and content, and the quality and clarity of the content, please consider subscribing to our channel today and turn on the notification bell so you can be informed in real time whenever we drop a new show. And we do so every single day, rain or shine. Please also comment and share your experience, like the content, so we can all learn. Now, I've spoken about asset management and talked about wealth management, so you're not confused about the differences. Now, I want to talk about a hedge fund. Now, a hedge fund typically is a pooled investment vehicle that utilizes high-risk investment strategies in the hope of garnering sizable returns. All right. So if you think about it, they want to beat the markets and they want to earn double digits returns. So a hedge fund is generally a limited liability company or a limited partnership, right? And the thing is that this kind of organization seeks the financial assistance of rich people, right? Because the clients of those vehicles, of those hedge vehicles, are usually extremely wealthy people, because the risky nature of their investments, the risky nature of their asset allocation processes is too much to bear for lower level investors. All right, a hedge fund manager will often approach possible clients with a specific investment strategy that he or she believes will boost the fund's performance. Right. So the thing is that when it comes to hedge funds, there is a strong competition out there, right? And most funds will try to get clients by saying, we have a proprietary strategy. We have a unique strategy. And research has shown that it's not really the case. They're just trying to put a spin on their own products, right? They're trying to put a spin on their strategy. Now, there are several strategies when it comes to hedge fund management. Now, they have something called long short. Now, the strategy long shorts, the goals here are to purchase undervalued stocks and to short sell overvalued stocks, right? So they just, I would say 100% invest in stocks, equities, right? You also have a strategy called global macro. So what they do here is they opportunistically sell and purchase investments related to national and international political and economic events. Right here, the catalog of securities invested in is larger. So you have bonds, ETFs, currencies, and commodities and options. They also have futures. All right. And by doing that, global macro, the strategy tries to maintain global diversification. Right. Now, you also have market neutral. That's another strategy. And this kind of strategy entails an investment in an equal amount of short stocks and long stocks in an effort to avoid risk. And again, the investment types are usually stocks. So what I'm trying to, the three types of strategy: long, short, global macros, and market neutral, exist in the market. So when a hedge fund manager tells you he or she has a proprietary strategy, you bet it's just a refurbishment of the three, or one of the three, or one. I mean, it's basically just like I said, a reformulation of any of those three. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi, and we'll still continue our conversation around asset management versus hedge funds, which is best for you. Now, I want to tell you how to find hedge funds and asset managers. Right now, in the country, you have hundreds of asset management firms, right? And the thing is that firms and sometimes even each advisor within them can have their own areas of expertise, right? Which makes them better suited for certain client archetypes. Now, you have to understand that the overwhelming majority of these firms, they must file something called Form ADV with the SEC, because and you want to read, or you want to have someone read for you while doing the research. You want to read this all important documents because they provide details on every aspect of a firm's services. Right. So as an investor or potential investor, this is a great tool for you. Right now, just go on the SEC official website, sec.gov. There is a feature that allows you to search for registered investment advisors, the RIAs, near you. So you put in your zip code and you're able to find registered investment advisors in your area. Now, the thing here is that hedge funds, so what I just said applies to asset management firms. It also applies to hedge funds when it comes to SEC registration. But the hedge funds, their situation is a little more complicated because they are not under constant SEC supervision, unlike the asset managers. So hedge funds cannot advertise themselves to the general public. So what you want to do is, for you to invest in a hedge fund, you gotta be referred by someone in your entourage, or you gotta have some sort of relationship with one of the managers of the fund, right? Or you have to be basically drawn into the equation. You have to know someone who knows someone who knows someone, because otherwise, for you to invest in a hedge fund, you need to be an accredited investor. Now, SEC requirements state that accredited investors are individuals who meet at least one of the following stipulations, and the rules are on the SEC website. So you need to have an individual or joint net worth of no less than $1 million. You need to have either a $200,000 individual or $300,000 joint annual income over the last 2 years, with an expectation of earning the same in the future. You need to be a registered broker or investment advisors. So you need to meet at least one of the three stipulations. Now, when it comes to asset management and hedge funds, which is best for you? Now, this is very important. And hear me out. How risky can you afford to be with your asset? This is the number one question you need to answer before determining whether you should go with A, an asset management firm or a hedge fund? How risky can you afford to lose your assets? So let's say you want to put 500,000 in a hedge fund or an asset management firm. Can you afford to lose those? Let's say, the fund or the firm you invested your money at just went belly up in the next 6 months. Can you live without that 500,000? Right. So if you're not near retirement age and you are flush with cash, then it's just better to look into specific hedge funds, right? Because the cash is there, and you're good. Of course, if you got to meet the SEC requirements, right? Because in practice, not many investments can match the returns of a hedge fund, right? So you want to take the time to do your due diligence, to find out the track record of the hedge fund manager. You want to find out what kind of strategy they have and basically what they've been up to in the last 20 years or 10 years, for instance. And also very important, whether they are under some kind of regulatory scrutiny, right? So the what I'm trying to say here is that if you have any doubt as to whether or not you should put your money in a hedge fund, then I'm gonna tell you, I will say very clearly here that you should go with an asset management firm. If you have the slightest doubt, it means you're not ready for hedge fund. You're not ready for hedge funds. You might as well just go with an asset manager. All right. Now the thing here is that, and you might find it. I mean, this could be a good transition, a good segue into the hedge fund world in a few years from now, really, right? So first things first, maybe you start with an asset manager and then move on to a hedge fund. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. If you just joined us and you want to know the context of today's conversation, we have talked about actually asset management versus hedge funds, which is best for you. To become a successful investor, you can either plan, execute, and monitor your own investments, or entrust those tasks to experts working at two specialized institutions: asset management firms and hedge funds. Despite the similarities in both investment styles, each option has its own subtleties that can more or less match your personal financial situation. Find out what works for you before making any final decisions on your finances. So to find out what works for you, I gave you five pointers, right? I explained to you what is asset management. I told you what is wealth management. I told you what is a hedge fund. And I've told you how to find hedge funds and asset managers. And most importantly, asset management versus hedge fund, which is best for you. Now, when it comes to choosing asset managers versus wealth managers or versus hedge fund managers, you got to think about what services do you need, right? Do you want to choose and manage Do you want someone to choose and manage your investments? Then go for an asset management firm. Do you want someone to look more broadly at your financial life and portfolio? Then go with a wealth manager. You have to understand, some financial advisors do both, so you can hire just one person for the job, right? Now, before you hire and you work with an advisor, whether it is wealth management advisor or asset management advisor or even a hedge fund manager, make sure you understand how much their services will cost. So you want to talk about the structure of the fees and how much you can expect to pay. This is very important, right? So you want to think about that. This is very important, especially if you want your retirement savings to be managed by, an asset manager or wealth manager, right? So you have to understand that financial advisors have experience with financial planning, so they might be the ideal partner to build your retirement plan with. But the thing is that whether they're part of your overall wealth management plan or asset management plan or hedge fund plan, you need to vet them. You need to know how much they cost and what services they can bring you, what value they can bring to your portfolio. All right? Thank you so much for listening to me. I really appreciate it. I will see you next time. But until then, remember to stay marvelous.